If you really want to be a good value investor over the long term, you need to be a sociopath. That's a bit of a harsh statement, and I said it for effect. But perhaps a more elegant way of making the point is that you need to maintain professional detachment, a bit like a surgeon. You've got to be a good fiduciary and you've got to make good investment decisions. But if you start caring too much about how each decision will impact each client who you've known for a decade, you're going to get paralyzed by indecision. And if you find yourself in that position, it's time to leave.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Adam Saron, who's founder of Clara-Pensions and was its CEO until April of last year. Clara is the member-first consolidator of defined benefit pension schemes and the only super fund to have been successfully assessed by the UK regulators. He previously ran Black Ant Investment Management, a long-biased value investor, which invested in both public equities and corporate credits. Welcome, Adam. Thanks for joining me today.
Thank you very much, Ethan. It's a complete pleasure.
Well, great to see you again. And I'd love to go back and ask about your background and career journey. Where did you grow up? What were your early interests? And how did you come to enter the world of investing and finance?
I suspect my accent's a bit of a giveaway. I grew up in Johannesburg in South Africa. My early interests in order were rugby, karate, and academics. It turns out, however, that my abilities were probably ordered the other way around, and I had a great time at high school and was lucky to attend a great school with a long tradition of academic excellence. As a result, I had a lot of choice of what I might pursue at university, but like a lot of people, actually, very little idea of what I wanted to do with my life. And again, like lots of others, I chose a general business degree as somewhere to get started and discovered that I was fascinated by economics, finance, and law.
So that sounds like a fairly conventional trinity of interests. Will you say there were any surprising turns in terms of where your career took you?
Yeah, I mean, I think I had a very sort of traditional and sort of standard academic background, but it feels like my professional career has been nothing but surprising turns, in honesty. The South African system's a bit like the US. Law's a postgraduate degree there, and I decided that was the path for me. But I got very lucky and had an incredible opportunity to study law at University College in London. And then in the summer of my first year, I got a vacation job in the legal department at Goldman Sachs, which actually turned into a part-time job in my final year. And I guess that was a great advantage of being at uni in a big city like London. And I was captivated by investment banking, and I absolutely loved the study of law, but I was not that keen to practice it. So shocked everyone, shocked my folks, and decided to turn down my training contract at one of the Magic Circle firms. After 20 plus, maybe it was 25 interviews, I can't even remember now, I was hired by Antoine Schwartz to join the equity capital markets team at GS. And that was another lucky moment because years later, Antoine invited me to launch Black Ant with him.
It's really interesting how parallel our paths were, because I also started as a lawyer and became fascinated by investment banking. Didn't have the luck to be hired by Antoine Schwartz at that stage. But one thing I always sort of refer back to is I don't think any of that legal training was in vain. I think there was a lot of great perspective, depth, certainly the ability to write that comes with studying law. What would you say you took from those years of study and your interest in it into the work you did in investment banking?
Yeah, I mean, even though I never practiced as a lawyer, I always felt that the discipline of academic study of law particularly develops three specific skills. It teaches you to process, retain, and mentally organize large quantities of data. It also teaches you attention to detail, and slightly separately, attention and appreciation of nuance. Investment is not just about the numbers. Everybody thinks it's a numbers game, but it often requires comfort and familiarity with complex legal documents. And I found that very helpful, particularly as a junior professional, to have those hard skills, because it helped me build credibility and trust very early in my career with colleagues and clients. And that in turn gave me the space or time to learn some of the other skills that have really benefited me through the rest of my professional life. So yeah, it was a great start.
It's interesting also that focus on nuance, because I think certainly as we get more advanced in our careers, it's really the nuance where everything matters, less about the kind of black and white categories. And also, I would think there's an element of judgment that law teaches you when it comes to assessing management teams, whether that be of portfolio companies you invest in or maybe companies you look at on their pension scheme side. So really appreciate that detail. So when did you first become interested then in defined benefit schemes and some of the challenges that they face?
Well, the short answer is that I'm married into it. So in my house, my wife is the real pensions expert. She was a partner at one of the leading specialist pension law firms. She went on to be a professional trustee and a senior executive at one of the larger DC master trusts. She's left that a little bit behind her, and she's now a senior exec at one of the largest UK life insurers. But she had long been convinced that consolidation would help solve some of the biggest challenges facing defined benefit pension schemes. So the original idea and inspiration for Clara-Pensions was hers, and that's why the business is named after her. She's actually called Claire. Clara is sort of a family nickname.
Well, that wasn't the answer I was expecting, but a great story nonetheless. Talk us through then some of these challenges, because I would have seen this from my perspective as an advisor to the LGPS schemes in the UK, the local government pension schemes, which have for some years now been under a pooling mandate in order to achieve that scale. What kind of challenge have the schemes you've looked at been facing, and how does consolidation tackle that?
Yeah, so the experience you had is sort of I think the future world. Those bigger schemes that are getting even bigger and really taking advantage of their scale. But when you look across the other schemes that make up the vast majority of the DB universe in the UK, there's some 5,200 of them. It's highly fragmented, and you have all these schemes individually effectively repeating the same tasks, paying the same advisors, the same quite high fees. And, we can debate what the outcomes have been like. Consolidation isn't the answer to everything, but I think that scale, that strength, and the financial flexibility that gives you is a great way to start solving the bigger problems of accumulating the right assets at the right time in the journey, making the best risk management decisions, and driving good governance. These things cost money, and the economies of scale provides the resource to do it.
And it's interesting because we've obviously had defined benefit schemes under the microscope in recent months at the end of 2022 in the UK due to some liability-driven investing problems that some of them had on the UK gilt market and the sort of extreme movements there. What trends do you see in that arena? I mean, clearly we've seen fewer schemes open, more closed schemes, more schemes move to buyout, more schemes move to de-risking. What kind of trends are you seeing in that sector that are accelerating maybe over recent years?
Yeah, I think there are three pre-existing trends, which I think will continue to build momentum. And I detect a fourth counter trend, actually. So the three existing ones are firstly consolidation. I think there will be further consolidation in the assets, the liabilities, governance, and service provision to DB schemes for exactly the reasons you point out. The vast majority of them are closed, and effectively it's a business or industry in runoff. So it is going to consolidate. That is the natural reaction to that. I also agree with you that annuitization, or this journey towards, or rather pressure towards annuitize and buyout, is only going to continue. You certainly look at all the early predictions from the various actuarial consultants, and everyone's predicting another record year for bulk annuities, but actually they make that same prediction every year. So we'll see. And then the third trend is professionalization. Professional trusteeship is growing, and as more schemes are governed by these professionals, effectively you get consolidation in governance that way. But the fourth trend I actually think is really the interesting one. This growth in demand for bulk annuities is, I believe, unlikely to be met by a sufficient increase in supply. So actually the net supply position is going to get worse over time. And I think the result of that is that the schemes themselves, and particularly the corporate sponsors, are really starting to think about what are the alternatives to buyout. Should we be thinking again about how we might run these schemes on? Should we be thinking again as to how the scheme could be used to potentially deliver benefits to wider workforce? And that's particularly relevant in this moment of high cost of living. And the question that follows on for that is, or so rather are, bulk annuities good value for money? And are there better ways of spending it? So I think it's going to be interesting.
In series 1, Jonathan Hollow had a podcast where he focused on his book, How to Fund the Life You Want. And he spoke about the low level of, I suppose, interest, engagement, education among pensioners. So actually recipients of the pension plan over this extremely important area, as you mentioned, given the cost of living pressures. Do you experience that from your standpoint? And how would you suggest we can bridge that gap, getting the beneficiaries of these schemes more on board with learning about them?
I mean, it's a sad truth that engagement is a great problem for the pensions industry. I would say globally. I don't think it's a uniquely UK problem, and it exists in the defined benefit side and the defined contribution side. And I think the short answer is no one has an answer yet. I'm hopeful that, again, as schemes get bigger on the DC side and you see this consolidation on the DB side, perhaps there'll be the resource and time to spend some time thinking about this, because people have tried to use less jargon, communicate better, but it is very hard to get people to engage on something that is so many years away, but it sneaks up on you. And in preparing for this podcast and reflecting on my own career, like I'm thinking, wow, I'm nearly 50. My career is more done and more of it's behind me than it's ahead. And have I planned properly? And I'm a financial professional. This is a hard challenge.
It does sneak up on you. I'd certainly share that. I share that sentiment. Well, let's just go back a little just to make sure we don't completely gloss over it. I'd like to go back and just talk a little bit about value investing, because Black Ant, that was its focus as a long biased value investor, investing across the equity and the credit spectrum. Value investing seems to be one of those things. Clearly, it moves in cycles. It was a bit maligned in recent years as growth outperformed. And now it seems to be having its day in the sun again. What are your current thoughts on value investing, and how did you maintain your conviction level throughout that period?
Yeah, I mean, I think the one challenge I would throw out there, although I think you in fairness hinted at it, is that the underperformance of value versus growth, say from the global financial crisis to the end of 2021, I think was inextricably linked to artificially low cost of capital driven by low rates, which I think maybe were kept too low for too long. I'm also a bit biased. In my career, I missed the first dot-com boom in the late 90s because all my clients were either boring financial services companies or metal benders. So I grew up professionally with that value mindset, which just appreciates the downside protection that comes from visible and predictable positive cash flows. And 2022, the last year, has reminded some of the older hands and I think taught the younger professionals what rising rates do to growth stocks. So I think in investing, timing or vintage matters more than almost any other variable. So I know this is not a investment advice podcast and no one should take it as that, but I think the outlook for value is the best it's been in a decade. But always, for the right portfolios. It's not for everyone.
So watch this space. We can return to revisit the podcast in a few months' time when we see how it has worked out. But it has been an interesting study in people's conviction. And I suppose the age-old throwing in the towel at precisely the wrong moment, which may have happened with value investing here.
Yeah.
I'd love to talk about your experience founding and running Black Ant. Obviously, in any arena, there are barriers to entry. There's that engagement you mentioned, having to get engagement with clients, building it up, and just, I suppose, the reality of running a business. Can you talk us a little bit about that experience?
Yeah, we founded Black Ant in 2004, which is a kind of that golden or halcyon days for hedge funds or alternative investment funds. It was very easy to get engagement from potential clients. Everyone was looking for these kind of opportunities. But it's hard to found and operate a business. And we definitely learned three important things. The first is you really need to know who you are, who and what you want to be as a business, and you've got to focus on that. You've got to be ruthless about it. And I think in investment management businesses, it's basically about a binary choice. Either you're an investor or you're an asset gatherer. We wanted to be investors. We wanted to focus on generating returns for our investors and for our own capital. But the flip side of that is you have to be disciplined on fund size, and you can't grow for its own sake, because otherwise it's hard to keep up the returns that you want to make. And it's a tough decision to pass up on management fees, but that's what you have to do. The second and probably the most important lesson is that it's always good business to do the right thing. I think as an investment manager, particularly if you're running a more boutique or specialized operation, the best ongoing investment you can make is in your own reputation. Because at the end of the day, people are investing in you as individuals, in the managers. And there are plenty of good managers at BlackRock, and I'm not having a go. But if you're buying BlackRock, you're buying the platform. You're not necessarily buying the people who are making the investment decisions. And the third thing I learned was that if you really want to be a good value investor over the long term, you need to be a sociopath. That's a bit of a harsh statement, and I said it for effect. But perhaps a more elegant way of making the point is that you need to maintain professional detachment. A bit like a surgeon. You've got to be a good fiduciary and you've got to make good investment decisions. But if you start caring too much about how each decision will impact each client who you've known for a decade, you're going to get paralyzed by indecision. And if you find yourself in that position, it's time to leave.
It's so interesting because I'm fascinated by the psychology of what helps people learn how to take risk and maybe gain that level of, I suppose, detachment that you mentioned there, because that's not an instinctive thing that many are born with. How would you say you learned that? And how can others learn that in terms of learning to take risk like that?
I think I found that as we went through the Black Ant journey, I got worse at it actually. And ultimately, that's why I decided to leave. We had had such an up and down journey from beginning of 2004. It was all go, go, go. And then a very tough crisis and then building the business up again. And it really felt a lot of duty and obligation to the investors who had maintained faith in us. And I do just remember that the sensation, and every investment manager knows this, the worst day of the year is January 1. It's awful because everything is reset to zero. Doesn't matter how well you did last year, you've got to start it all over again. Everything starts again. And I think it's incredibly hard. I think the only way you get there really is, say, you've got to become a little cold-hearted. You will become more cold-hearted, not less. So if you don't feel that developing in yourself, take what you've learned, take your skills and find something else to do. Just be honest, because if you do care, the worst thing you can do is stay an investor when your mind is not attuned in the right way.
Really interesting perspective. Well, thank you for your honesty in that respect, because it is always, especially with the active versus passive debate that rages, it's always coming under scrutiny. And yes. I think we'd like to think there's goodwill and loyalty there. Obviously, that's why we build client relationships the way we do. But at the end of the day, people are more mercenary when it comes to measuring performance. So I can understand that would be upsetting for them as the year starts again. Just tied to that a little bit in terms of team building, etc. I ask everyone this question on this podcast around diversity. So you have worked in the investment management industry for many years now. Have you seen any improvement in how diverse, how inclusive that has become over the course of your career?
I think the short answer is yes, and none too soon. In fact, it's probably way too late. If it's trying to score the industry, I'd probably give it a 4 out of 10. I suspect that some, if not most listeners will probably think I've been quite generous. And so maybe I'll try to unpack that a little bit. In all financial services, and particularly investment management, the biggest single cost line is the people. And that makes total sense. But it feels to me that the penny has finally dropped for the industry, and that they've realized that by not seeking the brightest talent from the widest pool, they're effectively paying a higher cost for a less than best resource. So, maybe the progress isn't necessarily coming from a good place, it's coming from quite a mercenary place, but it is finally having results. I think there has been a change in perspective, but it'll probably still be slow. I think it'll be quite some time yet before it feels like the challenge, and more importantly, the opportunity of D&I is fully realized in the industry. It's kind of interesting that coming from investment banking in the 90s and then investment management hedge funds in the early 2000s to the pensions industry, it actually felt to me that pensions were quite diverse. Now, people within the industry would say, oh, it's pale, male, and stale, and they're probably right to a greater extent. But the relative comparison has always seemed quite stark to me. And fascinating that the pensions regulator, often criticized for being slower and maybe less sophisticated than some of the other prudential regulators, has been far ahead in terms of advocating for greater diversity and inclusion. It's an interesting fact that professional trustees are probably the only group of financial professionals where the average pay is higher for women than men. So there's hope.
It's really interesting. I suppose from my perspective, where I might attack the diversity of the pensions industry is cognitive diversity and the dangers of groupthink. And ironically,
we've seen that recently.
Yes, exactly. And ironically, of course, if we go to more pooling, we'll have bigger, more groups, more groupthink. But I do think that kind of underscores the importance of that independent voice at the professional trustee.
Yeah, and I think that issue around groupthink is, and again, I'm not trying to necessarily have a go at the advisory community, but it's quite often driven from that relationship because for the most part, trustees, professional otherwise, are non-executives. And except for the larger schemes, like the BTs or USSs of the world, those schemes actually lack an executive function. I'm hopeful that with consolidation, you will start seeing a growth of a true executive that serves the trustee and helps develop some of that real challenge of the advisors. Because I think that's quite often where the groupthink has been sourced from. Because as a consultant, I understand the business model works best if you generate a piece of advice, you generate a concept, you want to try repeat it. That's how you make your business work the best. But it's not necessarily the best thing for the industry or for the economy as a whole.
And then the other conundrum is also cost. It would be nice to have a second advisor to maybe challenge the first advisor. But then you have the issue of, well, how many line items do you want to have when you're always focused on return, cost, the bottom line? And that perhaps, again, gets in the way of having that kind of devil's advocate in the room.
Yeah, and totally impossible for the smaller schemes. But again, for the big schemes who are so big in asset terms and liability terms, the relative impact of those costs is much lower. So maybe they can afford that kind of idea. And I think that it's interesting to actually pay for the second opinion. You would if you had a medical condition. That's something you do automatically.
I think that has to be our new campaign. I'm all about the second opinions. So we will park that idea, maybe come back to it another time. I'd love to get back to some personal reflections now. Over the course of your career, would you say there were any highs and lows? And of those lows, did you learn anything in particular from them?
I hope so. So I think where I started at Goldman, there was an undoubted early high. I worked like crazy with great people, but it gave me an incredibly solid foundation for the opportunities that came later. I think the whole experience of Black Hand, it's kind of two highs forming brackets around a very harrowing low. It was exciting to be part of the team at launch and growing the investment business. But the low of the financial crisis was very low. And I'll put my hand up and admit that this was compounded by a large exposure we had to Bear Stearns. Interesting, though, the real high actually came from the recovery from that event. We did the right thing. We didn't close our fund. We didn't lower high watermarks. Rather, we promised our investors that we would work to recover both their original investments and their prior high watermarks. And we achieved both those things. And I'm really proud that every investor who kept faith with us had positive returns. I'll go back to the point I made earlier. Doing the right thing was good business for us because alongside that, we were able to rebuild our AUM to exceed our pre-crisis highs. It was really fulfilling. And the whole Clara-Pensions experience has been the highest high. I may have stolen the idea from my wife, but it's been a singular privilege to be involved in creating something new and a new solution that delivers better outcomes for pension scheme members. It's great to have purpose. And the other side of that is, sometimes I talk about it, I think people might sense that I did it all by myself, and I absolutely did not. Quite the opposite. And the people I worked with have been a key part of that experience. In building Clara, I had the chance to work with my co-founder, Kim Toker, who is also one of my oldest friends. So it's been fantastic. But you also learn that not everyone, not even the founder, travels the full journey. And that is the way of things. And it's a hard lesson. It's not one you want to learn, but given the chance to do it all over again, I absolutely would.
It's so true. I think all those bad experiences, whether it be market downturns, that kind of knot in your stomach feeling that can last for weeks at a time, we wouldn't be the professionals we are without them. And I think whereas you would never want to take them on, you would never wish them on anybody, they are without a doubt where the best lessons are learned. So I really appreciate that sentiment there. You spoke about key people and the joy you've had in working with them. Would you say if there are one or two people who were influential at pivot points in your life or who influenced you as mentors that you can mention?
Yeah, absolutely. I would start by mentioning Jim Zapersky and Antoine Schwartz. The two of them actually hired me at Goldman. They put my feet onto the path of my career. It's a bit unfortunate that Jim liked to work in the mornings and Antoine liked to work at night. So I just worked all the time, but I learned a lot. Jim's from the Midwest and he taught me the value of humility. And Antoine taught me about investing and invited me to join him in launching Black Hand. So very strong formative lessons from those two guys. But without a doubt, the biggest influence on my life and career has been my wife. Apart from giving me the idea for Clara, when you start a new business, it's so all-consuming that your family become investors too, voluntarily or involuntarily. At the very least, they're giving up a lot of time with you. And Claire is the absolutely crucial support in my life.
And tied to that, in terms of wisdom that any of these people may have imparted to you or other nuggets that you've picked up along the way, is there any creed or motto that you live by?
I don't think I've got a single creed or motto, because I think circumstances change, and you want to keep mental agility, flexibility to change if you have to. And that kind of thing can ossify your thinking. But the one piece of advice that really does stick in my mind, I actually learned on the first day of Goldman Sachs analyst training in the summer of 1997. And I really wish I remember her name, but it was a VP, and she stood up in front of us and said, never do or say anything that you would not be proud to see reported above the fold in the Journal of the FT. And I never thought I'd be involved with something that received as much media attention as Clara did, but I'm certainly proud of everything. And I think it's a good way to go through life. You at least have to be proud of things that even the things you want to keep secret. Then you are doing the right thing. It's so important. There's just no shortcut to that.
That's a good life lesson there. My last question is around any advice you would have for your younger self if you were to go back to that young student in South Africa with a passion for rugby. And I forgot the other one, but there was something on
karate.
Oh, okay, but clearly not something that became a career.
No.
Would you say, given the path you've taken, law, investment banking, is there any advice you would give that young man?
I would say listen to Jim Zapersky. And when he tells you that your life and career are a marathon and not a sprint, he's actually giving you valuable advice and wasn't just trying to avoid paying you a bigger bonus. That's the thing to remember. It's a marathon, not a sprint. And you never know where it'll take you. So you've got to keep your energy up.
Well, as a marathoner, I can certainly relate to that. And I can also probably relate to maybe not listening a great deal to advice at the young stage of my career. So whether you would have listened or not, maybe that's open to question. Well, Adam, it's been a great pleasure to chat with you here. The richness of this conversation has taken us into unexpected places, and I've really enjoyed your honesty and your openness about the industry we're in. And I'm delighted that we reconnected over LinkedIn. So thank you for coming here and for sharing your insights with us.
Thank you very much for having me.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.